If you have ever used a DIY tax software, you have seen this warning. Most couples save more by filing jointly. And for about 95% of people, that is true. But what about the other 5%? For some couples, filing a joint return is a multi-thousand-dollar mistake. Today, we are looking at the Internal Revenue Service rules for married filing separately. I am going to show you the 3 specific scenarios where this unpopular status is actually the smartest financial move you can make. Please note this presentation is for educational purposes only. It is not a legal or tax advice. Alright, let's have a look on the first scenario, the student loan strategy. The number one reason why my clients file separately is student loans. If you are on an income-driven repayment plan, your monthly payment is based on your adjusted gross income. If you file jointly, the government looks at your combined income. So for example, if you earn $60,000 and your spouse earns $100,000, your student loan payment could skyrocket. By filing separately, the loan servicer generally only looks at your $60,000 income. Yes, you might pay slightly more than in taxes, but if it saves you $800 a month in loan payments, you're still coming out way ahead. It's all about the total cash flow, not just the tax refund. Then the second scenario, the itemized deduction lock-in. Here is a major IRS rule you need to know. If you file separately and one spouse's itemized deductions, the other spouse must also itemize. They cannot take the standard deduction. This is usually a disadvantage, but it is a trap if you aren't prepared. However, it becomes a strategy if one spouse has massive out-of-pocket medical expenses. Remember, you can only deduct medical costs that exceed 7.5% of your adjusted gross income. By filing separately, you lower that adjusted gross income threshold significantly, potentially unlocking a massive deduction that would have been diluted and lost on a joint return. Let's have a look on scenario 3, the community property complication. If you live in a community property state like California, filing separately is a whole different ball game. According to IRS publication 555, you don't just report your own W-2. In these states, the IRS generally considers half of your income to belong to your spouse and half of theirs to belong to you. This makes filing separately much more complex because you have to split your income on your returns. If you are trying to file separately to keep your finances completely secret from a spouse in these states, the IRS rules might actually make that impossible without a formal prenuptial agreement that waives community property rights. Before you make the switch, you need to know what you are giving up. When you file separately, the IRS takes away several perks. You generally can't take the earned income tax credit. You also lost the child and dependent care credit. You cannot deduct the student loan interest. And your tax brackets are much narrower meaning you hit higher tax rates much faster. Filing separately isn't just about ticking a different box. It is a calculated move used to protect your refund from a spouse's debt, lower your student loan payments, or maximize medical deductions. The IRS website gives you the forms, but it doesn't give you the strategy. If you are not sure which status is right for your marriage, let's run a side-by-side comparison for you. If you need clarity in your individual circumstances, please email us at hello@usautax.com and we will be happy to assist you. Thank you for joining me and see you in the next video.